Hi traders, I'm Lance Beggs from YourTradingCoach.com. I was chatting to another trader this morning about exits and thought it might be time to share my understanding of the basics of exit strategy and exit management. It really is an area of trading that gets very little attention compared to the other end of the trade, the entry. Go into any Forex trading forum and you'll find thread after thread talking about the latest entry method, but very few threads having an intelligent discussion on exits. It's my belief that your success in trading has more to do with how you exit your trades than it does with your entry. Now, in discussing risk management today, we're not going to consider the use of defined risk options strategies. I believe they're a great technique for risk management in a swing trading or position trading time frame, but that's perhaps the subject for future articles or videos. For now, let's consider standard stop loss placement and exit management. So what's best? Should we use a tight stop to cut any losses quickly, or a wide stop loss to allow some room to move? How quickly should we move the stop loss to break even? Should we take profits at a target, or should we let the profits run, perhaps trailing a stop behind the price? Let's look at some example charts from the British Pound US Dollar 5-minute time frame, although the principles are the same for any market and any time frame. In this chart, let's assume our setup was a moving average cross occurring here. And we entered long at the close of the candle, first green candle, here, or the open of the red candle. The entry point is marked at 1.9727. A tight stop might be the point marked SL1, just below the green candle here. A wider stop might be at position SL2, below the recent swing low and the 1.9700 level. So, is this a good trade? Well, really our profit and loss depends on how we manage our trade and where we exit. If we took profit at the 1.9750 level marked as A, up here, due to expectation of a pause at that round number, then we had a good trade. If we move the stop loss to break even from either stop loss 1 or 2 on the initial rally and got stopped out at position B here, then I guess it's a good trade as well, although we have no profits to show for our work. If we hadn't moved our stop loss to break even though, we had another opportunity at C, up here, for an exit at the 97.50 level when price stalled there a second time. Once again, a good exit in hindsight. If we didn't take that though, perhaps because we've heard it's best to always let our profits run and to trail stops below the swing lows, then maybe we were stopped out at D for a couple of pips loss. At this point here, as price broke below the swing low at B. This is not a great result at all, but at least the loss is small. It's certainly better than the larger loss, after having been in profit for quite a while, that occurs when stopped out at point E, as price breaks below SL1, stop loss 1, or the even larger loss at point F, as price breaks below the wider stop loss 2. And of course in this case, if you've acted out of fear and failed to exit all at stop loss 2, and held onto your trade, hoping, wishing and praying for the market to turn around, you've been rewarded as an economic news release turns the market and moves it in your favour to much higher profits. And the market actually went quite a bit higher than this off the right hand side of the chart. So what was the best stop loss technique in this case? Certainly the gambling approach here, no stop loss at all, but there's no way any serious trader will consider that a valid approach. The market could easily have moved rapidly in the other direction, and possibly will for that trader's next trade, or the one after, taking them a massive step towards ultimate trading failure. For those of us actually interested in risk management, taking profits at predetermined target, in this case the 1.9750 level at point A, up here, was clearly the best result. Trailing stops just did not work, and a tighter stop loss, in this case stop loss 1, was clearly better than a wider stop loss at stop loss 2 in minimising our loss when the market failed to carry through to higher prices. Let's try another example. It's the same chart as before, we've just moved slightly forward in time. This time we've identified the failure to breach the 1.9750 level on 2 occasions, here and here, followed by the establishment of a lower low. We'll enter short on the break of that lower low occurring here at 1.9715. Those employing a tight stop loss might place it at position SL1 above the recent green candle and doji, and for those using a wider stop loss, it might be placed in the vicinity of SL2 or stop loss 2 above the swing highs. So what works best here, a wider stop loss or a tighter stop loss? Taking profits at predetermined target levels or trailing the stop? In this case, we have a target perhaps of the zeros level down here. which leads to a profit point marked as A. Good outcome, we've banked a profit. If we'd prefer to see a bit more of a stall at our target levels rather than just a touch, then possibly we held on and got out at B here as the break below the zeros failed. Still a good outcome, the same result as before, around 10 pips. If we don't take profit at target points though, but prefer just a trail or stop, then we've either got an exit at point C, here, D or E, depending on whether the stop loss had been moved to break even or remained still at position stop loss 1 or position stop loss 2. And this time our gambler has not had luck go their way. Holding the trade past the stop loss, or in fact having no stop loss at all, proved to be a terrible strategy as price continued to move higher and higher again off the right hand side of the chart. Possibly the last trade that person ever does, depending on how long they held on. So once again in this example, a tighter stop loss was clearly better than a wide stop in minimising risk if the trade turned bad, and taking profits at predetermined price levels was clearly superior to trailing a stop. But is that always the case? No, absolutely not. I simply picked two examples that show this outcome. Let's look at a third example. This chart shows an entry short on a continuation of momentum downwards, entering short at 1.9672 here. A tight stop loss may have been placed at SL1 above the long upper shadow. A wider stop loss may have been placed at SL2 above the recent swing high. In this case it's irrelevant how wide our stop is as the trade moves quickly in our expected direction. Taking profits though to our predetermined price target, in this case maybe a stall at the 1.9650 level here, point A, is clearly not the most profitable strategy. Trailing a stop beyond the swing highs would keep us in the market much longer. Here, here, and still in the market off the right hand edge of the chart for a total profit of around 100 pips. Clearly in this case trailing stops performed better than a predetermined price target. One more example. This time the market has broken down from where the price is labelled SL2. There is a rally with two large red candles suggesting a continuation of momentum in the down direction. We had a short following the second large red candle just here at 1.9530. If our strategy was to use a tight stop loss, we might place it in the vicinity of SL1 just above the highs here, while a wider stop, if that was our strategy, might be placed above the swing highs up here at the start of the downtrend, marked as SL2. In this case, a tight stop loss takes us out of the market at the upthrust shown by point A here, while the wider stop loss at SL2 clearly allows us the necessary room to move until the position gets into profit. Taking profits at a predetermined price level, in this case a stall at the 1.95 level, marked as B here, is again not as profitable as trailing the stop loss lower above the swing highs. So this time a wider stop loss is the better strategy on entry, and for ongoing management of the trade we're better off trailing a stop than exiting at a predetermined profit level. So what have we learned from these examples? This is what I've observed. In each case the profit or loss taken out of the trade was more a result of our chosen stop and entry method. Correction, our chosen stop and exit method, not our entry. For the same entry, there were numerous possible exits, some profitable, some break-even, and some at a loss. This is why I say that, although it's important to identify a high probability entry, it's much more important to focus on the exit. And secondly, we cannot know, except with hindsight, what will be the most profitable exit strategy for that particular trade. Sometimes a tight stop is best, sometimes a wider stop is best, and for ongoing management of the trade, sometimes a profit target is best, and sometimes a trailing stop is best. Okay, so the exit is more important than the entry. That's good. But there can be no perfect exit strategy that best manages every trade. That's not good. So what's a trader to do? We'll follow up later in a continuation of this video when I discuss the exit principles that I've found work best for me. Till then, no matter where you place your stops, never hold your position as price moves past your stop loss, wishing, hoping and praying for it to come back into profit. That's gambling, it's not trading. I'm Lance Beggs from www.yourtradingcoach.com. Wishing you happy trading and